I got a question. The last time I spoke was with Dan when she was alive, and he advised me to take my 401k from Wells Fargo and put it in Fidelity. So now I've got this guy that came over, talked to me about the company SILAC, SILAC, and I think it's just like a fixed index. With my money, if I put because an example, if I put $100,000, that my account will have a value of $110,000, and there says minimum guaranteed value 87, cash value 87. Lifetime withdrawal the first year you can, wellness withdrawal none until the second year, and after 1 year, I'll get $4,041, I guess. And anyway, what is stating here is that if my money goes there, at the end of the year, if the stock is up and it's $10, it will go to $110, and but if it loses, I still keep my money. I will not lose. That sounds kind of good. Sounds good in a way. But I think that this have been great when I was 60 years old. Because right now I'm 68, my wife is 70, and right now I don't have 100,000. Well, in Fidelity I got 91 because I guess the stock's going up and down. And in principle I have 61. Of course,
Okay.
I said I only can take 10%. If I take more than that, I get a penalty. So I'm not sure whether I should change that or just leave it the way it is.
Mm-hmm. So I'm glad you threw all of those details out, because what we have to get down to is, what are they promising and why would you consider it? So it sounds to me, so the company that you mentioned is an insurance company, and the product that they're offering is an annuity. So annuities have the unique ability to give you some guarantees. So when you're talking about stocks and bonds and securities and things like that, investment professionals can never use the word guarantee unless they're guaranteeing that you could either have a loss, a gain, or just be flat, and that's just pretty ambiguous. But annuity companies can offer you certain guarantees. Well, why can they do that? Because they charge you a fee every year. They charge you insurance to insure something. Now, these insurance contracts are very complicated. My experience is that most people don't really understand what they're being promised. It just makes them feel good that they're being guaranteed something, even though they don't really understand what the guarantee is. So why can insurance companies offer these guarantees where you can't get these guarantees in the market? Well, it's because they have certain amount of money on reserves. Why would they do it? Because they know for the most part, it's going to be statistically beneficial for them to do so, meaning that they're not going to have to make good on the promises or the guarantees that they're making, because they understand that they're going to take your money and they're going to invest it in a way that you're too scared to do, and they're going to keep the reward for doing that and pay you what they promised to pay you. So to me, annuities are very complicated. Most people don't understand them. That's the biggest criticism. They are expensive products, so you're going to get some minimum guarantees to quench your fears, and then the insurance company is going to be the one to win. The other thing that you have to consider is, and maybe you want to talk to the person that's offering you this product, is how much they're going to get paid if you buy it. So annuities are very high commissioned products. You need to ask the person, what do they benefit? And all financial advisors all financial professionals are not financial advisors. So you need to ask them some questions. What is their compensation for doing this? It's required by law. They should be telling you all of this up front. But how do they benefit for doing it? Are there any other products that they could offer you? Maybe this is the only thing that they have to sell. Maybe that's the only thing that they're licensed to sell. So, if all you have to sell is a widget, then everybody needs a widget. So you have to ask them, ask them some tough questions. How is this the best product for me? And have them explain those things. And then ask them a lot of what if questions. Well, what if this happens and what if this happens? And you want to ask them, you want to repeat back to them what you think the guarantee is. So is it the case that I can never lose money in this product? And then have them explain it to you. If you have a good understanding and they give a good answer and you understand all the risk, then you might want to proceed. But annuities are not my favorite product.